Good afternoon, everyone, and welcome to our webinar discussing the One Big Beautiful Bill. I am Chris Bartek, your moderator, and I serve in operations here at Revolution Group. Participating from Revolution are Ryan Fleischer, founder and chief investment officer. Joining Ryan is Kent Van Horn, certified public accountant with over 4 decades experience in tax planning and accounting. Ryan and Kent will guide you through 10 points we have selected directly relating to the bill. For those of you who are not familiar with Revolution Group, Revolution was founded in 2019 and is a real fiduciary focusing on private wealth management, serving individuals, families, foundations, endowments, and family offices. So we cover a lot. And with that, Ryan, I will have you give our audience a little bit more clarity on Revolution Group.
Yeah, thanks again, everybody, for joining us today. We really appreciate you taking the time to learn more about the big, beautiful bill. And I'm going to just take this opportunity while we have a little bit of a platform here, since we're hosting, just to tell you just a little bit more about Revolution Group. So Revolution Group employs a total and complete picture approach to understanding our clients' individual and family objectives, needs, essential considerations, and relevant questions. We strategically deploy top decile private investments alongside traditional asset classes in a purposeful, tax-efficient manner, leveraging our established record of success, custom to each client's unique circumstances. Through this process, we provide our clients with unparalleled purpose, clarity, and exceptional experience and value that distinguishes us in the industry as head and shoulders above our competitors. If you have complex issues and/or need for world-class portfolio construction and management, we would appreciate the opportunity to connect with you and learn more about your individual situations. With that, I again appreciate you for all being here. And we hope to not put you to sleep. So we want this to be as interactive as we can. I think most questions we'll save to the end of this recording. But with that, Chris, I'll let you take it away.
Right. Thanks, Ryan. So as Ryan mentioned, this webinar will be recorded, and there will be time throughout as the webinar progresses and at the end for Q&A. So please do send in those, and we will address them as we receive them and get as many of your questions answered as possible. The One Big Beautiful Bill is over 1,200 pages in length, which is no short read. This webinar contains a few key highlights and represents our interpretation of the bill as we reviewed it. It was prepared for informational purposes only and is not intended to provide and should not be relied upon for tax, legal, and accounting advice. Please contact your own tax, legal, and accounting advisors before engaging in any transactions. So with that, I will turn it over to Kent.
Thanks, Chris, and welcome. As Chris said, my name is Kent Van Horn, and Ryan and I'll be walking you through some of the highlights of the One Big Beautiful Bill. I've heard several different abbreviations for One Big Beautiful Bill, such as OBBB, OBBBA, BBB, or even one clever reporter said OBBB. So, but for our purposes here, we're going to call the One Big Beautiful Bill BBB. So that's how we'll refer to it as we go through this. Now, before we get started with our slides and stuff, I have a tie on today. So Ryan introduced me to a new phrase yesterday that was the tax code for the informed and tax code?
Tax code for the
tax code for the uninformed. Yeah. So
okay.
My tie has ostriches on it. Some of them have their head in the sand, and some of them have their head up. So that'll be the informed versus the uninformed tax payers that are out there. So we hope we're going to give you a little more information here today to help you be one of those informed people with that particular tax code. All right, so before we get going here, a few things I'd like to, we'll briefly review. A few of the first few slides are going to be related to changes to adjusted gross income, deductions, and credits. Now, these may not be relevant to many of our clients, but they were in the news a lot over the last year, so I thought we'd at least touch on them. Then Ryan and I will spend most of our time reviewing the changes that are important to our clients. And this will include the bonus depreciation, opportunity zones, and section code 212, or excuse me, 1202, qualified small business stock. If you have any questions during the presentation, please submit them and Chris will let us know. I will try to answer the questions as we go rather than wait until the end so we can make it relevant to where we're at. For each change that we're going over today, I wanted to make sure that we had the effective date for it, a discontinue date if that applies, and then any phase outs that might apply to that. So we should have that for each of those. And then as we get into the slides, you'll see that, and my shorthand on the slide says you might see phase out and then 150K / 300K. And that translates to the deduction begins to phase out for single filers when their adjusted gross income, or AGI, is over 150,000 and 300,000 for married filing joint. Okay, so with that, we'll get into the adjustments to income for adjusted gross income. So the first one we're going to hit is that one that was in the news a lot, and that's no tax on tips, or we'll call it a pre-AGI tip deduction. And that's going to be a maximum of $25,000 per taxpayer. And these are pre-AGI tips will be reported on your W-2. This will be effective January 1st of this year and go through 12/31/28, which is the end of Trump's term. The phase out on that begins at 150,000 for a single filer and 300,000 for married filing joint. The deduction is reduced by the income over that threshold. For example, a single person making 170,000 would have $20,000 over that threshold, and 10% of that is 2,000. So there would be a reduction of that of the deduction of $2,000. The second one is the overtime pay, and again, that made the news quite a bit over the last year or so. And the overtime pay is $12,500 for a single and $25,000 married filing joint, only for the premium pay over the standard pay. Okay, so that if I make $20 an hour and I work an hour of overtime at $30 an hour, I have $10 of premium pay, and that's what would be reported in your box 19 of the W-2. So it'll be actually on your W-2 how much is the premium pay. Now there's a phase out for this. It's same as what it is for tip pay. It begins at 150,000 for a single and 300,000 for a married filing joint. Another deduction that we have above the line against adjusted gross income is that of charitable contributions for $1,000 per person or $2,000 for a married couple. This one starts on January 1st of next year. There is no expiration date on it, but it doesn't start till next year. A couple notes on that is it must be cash only. So you can't go down and donate to Goodwill or something like that and take that as that above the line charitable contribution. It's cash only, does not apply if you're itemizing. So we can't double dip on that for itemizing. And this goes into effect again January 1st of next year also, and we don't have an end date. There's a little bit of a partial phase out for taxpayers in the 37% marginal bracket, but we're not going to worry about that here today.
Yeah, real quick. So if I'm in the church pew and the collection comes by and I drop some cash into the collection and I'm a non-itemizer, can I deduct that, or what do I need in order to get that deduction, even though I'm a non-itemizer?
You would need the same documentation we have in the current world for charitable contributions. If it's $250 or more, you'll need a letter from the charity saying that you gave $250 or more and didn't receive any goods or services for that donation. If it's straight cash, you'll need to keep a pretty good record of it. I don't actually recommend giving cash. I don't like that as a transaction for taxes. So I would recommend writing a check or at least get an envelope that you can put your name on it so that the church or charitable organization can put that on there. I know a lot of even like the the red kettle people, you can they have non-cash options for donating to them, whether it's Venmo or something like that.
Okay, great.
Okay, we'll continue on with charitable contributions. So this one, so we have a 0.5% AGI or adjusted gross income haircut for charitable contribution when we're itemizing. Now this one surprised me when I looked at when the bill finally passed, because I didn't see this, and it may have been there, but I didn't see it in the House of Representatives. I didn't see it in the Senate version, and all of a sudden we have a 0.5% haircut on our charitable contributions. And the other part that bothered me about this is that right above it, we say we're going to pass a law that says we can deduct charitable contributions. So we want to try to influence social behavior through the tax code. And so we're saying you can deduct more charitable contributions if you're not itemizing. But if you itemize, we're going to penalize you and take a 0.5% off of that. So the way that works is that if a person with, say, $100,000 in adjusted gross income, they can only deduct the contributions exceeding $500. So it's a 0.5%. I call it a haircut from what you can take as an itemized deduction. All right, let's talk about standard deductions a little bit here. Okay, so the big beautiful bill increased the standard deduction by $750 per person, or $1,500 for a joint return. New standard deductions for 2025, and these will be adjusted for inflation each year, but 2025, our standard deduction is $15,750 for a single person and $31,500 for a married couple filing joint. Then we get, in addition to our standard deduction, now we've got a new senior deduction. The senior deduction is, again, good for 4 years, starting January 1 of 25, going through the end of 28. And that senior deduction starts to phase out at $75,000 in income for a single and $150,000 for married. And it applies even if you itemize. So this is not in place of itemizing deductions. It's in addition to our standard deduction for those 65 and over. Now, as an investment planning point here, if we have a couple, we know that these tax retirement accounts are tax-deferred retirement accounts are tax monsters. So at some point, you're going to have to pay taxes on that, whether you take it out and pay taxes on it, or your heirs would also be liable for those taxes. So we want to try to make sure that we're taking out those taxes at the lowest possible tax bracket for our purposes here. I'm going to use an example using the 12% tax bracket. And if we have couples who are not taking advantage of that full bracket, we would want you to do that to get the tax out of those deferred accounts and into that. So let's use an example of now we've increased our standard deduction to $31,500. In the existing law, we have an additional deduction for people 65 and over of $1,600 per person for $3,200. Now we have a new senior deduction for $6,000 per person, total of $12,000. That gives us a standard deduction of $46,700. That 12% marginal tax bracket that I referred to goes all the way up to taxable income at $96,950. That means total AGI of $143,650 is kind of that maximum where we would want to be to take advantage of that 12% tax rate. After that, the brackets jump up to 22, 24, 35, etc. on that. But if we can take advantage of that on every year to make sure that we're getting those pre-tax dollars out at the lowest rate, we'd want to do that. Okay, another change to adjusted gross income is the auto interest loan deduction. So this is going to be a pre-AGI, pre-adjusted gross income loan, and it's the interest. You can deduct the loan interest or the lesser of the interest paid or $10,000. Now these must be new cars assembled in the U.S. and to know if it's assembled in the U.S. and qualifies for this deduction, the National Highway Traffic Safety and Administration has a website that you can go to and put your VIN in and identify that. I actually just take the link from the IRS website because I spend more time there. Also, the vehicle has to be purchased, not leased. This becomes effective January 1 of 25 and expires on 12/31 of 28. There is a phase out there that begins at 100,000 for a single person and 200,000 for married filing joint. Now, the next couple slides are going to be related to those who itemize. So the first one is private mortgage insurance treated as mortgage interest. And I think those of us who are familiar with that know that really it doesn't benefit the taxpayer or the mortgage holder. It's the bank is charging them extra funds if they don't put down a big enough down payment. So to me, it's really like mortgage interest. And I think this is the right call to make this treat PMI as mortgage interest. So I'm glad they put that in. This doesn't go into effect until 1/1 of 26. So next year we'll pick that up. And the bill itself actually says MIP, which is mortgage insurance premium. That's usually paid by homeowners whose mortgage is insured by Federal Housing Administration or FHA. Most of us are used to seeing PMI or private mortgage insurance. For this bill's purposes, both of those will be treated the same as an itemized deduction. The next one is the SALT, or state and local income tax SALT deduction. That increased to $40,000, which surprised me because in all the drafts that I saw and all the discussion points that we saw in the news, most people were saying, well, that would be maybe $20,000, maybe $30,000 increase on that. So 40,000 was the high end of anything that anybody projected. And so I'm surprised, but that will work for us here in Nebraska when we have high property taxes. This phase out for this starts at 500,000, and that's the same for single and married, and which was the same under the current law where we had a limit of 10,000, and that 10,000 applied to singles and marrieds. And this 40,000 is also the same amount for single, filing single, or filing married. But so the phase out starts at 500,000. This is effective this year, current year, 25, and it goes through the end of 28. There are a couple of additional things that BBB did that I want to just point out. We don't have slides for them, but one is that the tax rates that came through in Trump's first TCJA tax cut and job act back in 18, 17, whatever year that was, those tax rates and the capital gain rates that came in with those were made permanent as part of the BBB. Also, QBI was made permanent. So BBB extended that 20% deduction for qualified business income. So that's the QBI. It added some increases for phase-in of income limitations and adds some inflation-adjusted minimum deduction of $400 for taxpayers with at least $1,000 of qualifying income from a qualified activity or trade or business. But that is now made permanent by BBB. So the QBI is now permanent. Now credits. This one, okay, they should not put me in Congress because it's like these people in Congress must not have kids. They gave us a whole $200 increase in our child tax credit from $2,000 to $2,200. And I think parents are grateful for an increase, but most people were expecting more than that. That does go into effect this year, January 1 of 25, and there is not an end date to that. There is a phase out, begins at 200,000 for single, 400,000 for married. Also, BBB made the estate tax exemption increase permanently to 15 million increase for inflation. This is effective in January 1 of 26. So that 15 million that we read about as the estate tax exemption starts on January 1 of 26. In 24, our state tax exemption was 13.61 million. In 25, the year we're in, it's 13.99 million. And then January 1, it'll go to 15 million. And again, I noted that that was indexed for inflation.
Kent, just so we're clear on this, our listeners and participants are clear. That's per individual, correct? Not married. So in essence, you would double the what you see here on the screen, to double the exemption amount. So again, where is this relevant? We have had clients that are over these exemption amounts. And we've had some that are very young. So planning purposes, the goal may not be to take every dollar off. It might be a flexibility type of purpose. You're still going to get the exemption no matter what. You no longer have to have the trust like you used to have to get the portability and exemption. So just keep that in mind when you're working with us. We're going to get creative and making sure to meet you where you are and give you the recommendation on what to do. Not really focused on taking every dollar off the burn exemption if you're young and healthy, but maybe if you're older, then we get more focused on trying to make sure every dollar that is sheltered from estate tax.
Right. Thank you for that addition there. Okay, let's move on to, there's some other business changes that we want to cover here. And the first one, I have to use a little of my accounting geek here because that's the only way you can really explain that. And that's they increased the floor on the business interest deduction. So the floor for what you can deduct on business interest is going up. So it's going to change to include earnings or EBITDA. So earnings before interest, taxes, depreciation, and amortization, EBITDA, rather than the more restrictive EBIT, which is earnings before interest and taxes. So the difference between those, the depreciation and amortization, and the EBIT restriction was there in place from 22 to 24. And so this is a good thing that allow businesses to have deduct that interest and have more cash flow available for other investments. This goes into effect January 1 of 25. So that's on that one I've seen it in the news quite a bit. A couple other things that are on the reporting side for businesses. So we increased the limit for 1099 NECs, so that's the non-employee compensation and / miscellaneous. Those two 1099 filing requirements have gone up to $2,000. That's up from the previous $600 figure that's been in place for quite a while. But that'll go into effect on January 1 of 26. Again, we want to make sure you understand the effective dates on these. That one goes into effect next year on January 1, and it increases those minimums to $2,000. The other one that changed was the 1099K. So a 1099K are these are the payments from third-party settlement organizations such as Venmo and PayPal. So what it did is it increased it to $20,000 per individual and 200 transactions. If your transactions and payment payout are below that, then there's not going to be a 1099 coming your way. We find that with people who are, president of PTO or some organization like that, and they're raising money. Well, they get 200 transactions pretty fast as people start donating to causes like that. So this will be effective for payments made after 12/31/24. So this year in 25. So the 1099 NEC is in 26. The 1099K is in 25. And we don't have a discontinue date on the 1099Ks or the NECs and the MISs. Okay, now bonus depreciation is back. bonus depreciation, 100% bonus depreciation is back. If you remember, we've been phasing that down from 100 down to 80 to 60 to 40. And now the BBB is permanently restores the 100% depreciation for qualified property, allowing investors in businesses and real estate to deduct the full cost immediately, enhancing cash flow for other investments. So this is going to be for assets placed in service after January 19th of 25. So it's in effect for most of this year, but that's a different effective date than some of the other ones that we've seen. Where it was January 19th. January 19th was inauguration day for President Trump. So they put the effective date of January 19th of 25, and that is a permanent change. We don't have the phase out like what we had before. BBB also created a new production property, so a QPP. So this is a temporary full expensing provision for certain non-residential building properties used for manufacturing and production. These properties were previously ineligible for bonus depreciation because of their longer 39-year class life. Before it was just 20-year class life and below that we could take bonus on. So, but now we've got this new one. It's for assets placed in service after January 19th and before 1/1 of 29. So just short of the 4 years that we've seen on quite a few of these other provisions. Now, Section 179 increased to 2.5 million. What is 179, you ask? Thanks for asking. Section 179 allows businesses to deduct the full purchase price of equipment and software in the current year. Now, one of the limitations on 179 is that the deduction cannot exceed taxable income for that year. So when we compare, and lots of people when small business people in particular say, well, do I take 179 or bonus? Do a bonus 179. The bonus depreciation can exceed our taxable income. The 179 cannot. So that's one of our key things that we're looking at when you're trying to choose between the two of those. So that increase goes into effect on January 1 of 25, and there's a phase out that begins at $4 million. So Ryan, I think we can say that together these changes are pretty powerful tools for capital intensive businesses, especially manufacturing, refining, and production. Could you walk us through a couple of examples of how investors might use these tools?
Yep, happy to, Ken. I mean, it's been very exciting since Trump reenacted and put the bonus depreciation into place for our clients from a planning perspective. The bonus depreciation became much more meaningful when it came to like a cost segregation type of study. Again, we're not condoning every time you should go cost segregation. These are generally for people that are repeatedly in the higher income tax brackets, where maybe have a sale of a property or a large tax consequence and a reallocation or something of that nature. So we're not into selling a transaction or selling an idea and running with it here at Revolution Group. It's 100% customized, but this will give you an example of implementation of a bonus depreciation. So if you went out and we went and found a $1 million property for our client or a part of a partnership, being that they are a limited partner, they're going to be privy to being able to deduct what they call that non-recourse debt. So if you invested $350,000 and you got $1 million worth of the property because there was $650,000 in debt, your basis, and effectively that's passed down to you on what they call your K-1 or your tax form, is actually a $1 million. All right. Also, you're gonna this property that you're buying, you hope it's going to produce income for you. It's an investment. It's going to produce something for you. In this case, we had it be an NOI or a cap rate of 6% annually, right? So given the federal tax rate, top tax bracket rate of 37%, net investment income tax of 3.8. We're going to assume you have the 3.8% net investment income tax that's taxed on because you're in a higher tax bracket to take advantage of this. the Nebraska state income tax at 5%. So collectively, you're in the 45.8% tax bracket, right? That's how we get the math on where you are. So taking that on a segregation analysis, now again, property to property is going to vary. Kent will tell you that. He actually questioned some of this math yesterday. Said, well, what kind of property would going to give you this type of bonus depreciation? Well, things like car washes possibly, or C-stores. They've written the bureaucrats of legislation. They must have a really powerful car wash lobby, but they allow for significantly greater bonus depreciation and cost segregation analysis. So there's ways we get creative depending on where you are, not only the type of investment and positioning that investment in your portfolio, but making sure we're taking that tax off. So in this case, this $950,000, that's your basis, even though you invested $350,000, you would be putting $435,100 back in your pocket. So it really sounds too good to be true. You basically got all the money back that you invested in equity. I know it's hard to make sense, but this is how you take advantage of the tax code for the informed, the tax code for the ill-informed. And we're getting very creative in this, but this is what we utilize here at Revolution Group to take tax off. So in this case, you have net tax savings, so net dollars back in your pocket. That's a net number of $435. Distributions of $6,000. So your first year cash flow of $495,100 with an initial investment of $350,000. Oh, by the way, that investment is going to be durable income and continue to produce a 6% annualized distribution. So that is one example. And again, I know the prior slide said general partner. You don't need to be a general partner to take off the loss. The loss will sit on your balance sheet until it's utilized by possibly passive activity, or if you qualify to offset those active income, you can certainly use those passive losses against active income, and we have ways to do that. This is example number 2. So this would be probably more for our family office type clientele that would be on the webinar today. We actually had a client that had a $30 million jet. And they were asking how to strategically do this. And we've actually moved this jet up to $35 million. To protect a little bit of their identity, maybe. They went out and bought this $35 million jet. They put $7 million in equity down, $28 million in debt. Now, this is a business jet. If you know anything about family offices, they generally have all kinds of partnerships, all types of things that qualify for businesses. There's all kinds of ways to qualify different structures as businesses. So in this case, it needs to be utilized for this bonus depreciation write-off. At least 50% of it needs to be used for business expensing, or 50% for businesses at least. The other 50% can be used for personal, take your family on vacations and things like that. Why it's not, that other 50% that you're not using it for business, you can charter. That's very common. A lot of people that own jets, they charter the jet. And let other people use it, but for a cost. In this case, it runs about $20,000 an hour. Same type of tax consequences, top bracket of 45.8%. Let's go to the next slide, please. In this case, the bonus depreciation, again, that's your basis, is the $35 million. You'd have a $16 million money back in your pocket by purchasing this jet. Okay, that's the math, because you get the full write-off of that. Now, in addition to this, you're also going to get a $5 million of ordinary income tax, $5 million of additional cash flow for a year. So your first year cash on cash here is $21 million back in your pocket on initial $7 million. Okay. Well, we know the rich get richer, and oftentimes this is the case of the last 2 examples that I gave you on how this works, right? It doesn't have to necessarily be this way. We're not telling you to go out, that everybody can go out and afford to go and buy a jet, of course, but this is, again, creative ways and creative strategies to take advantage of the new bonus depreciation. And I'll throw it back to you here, Kent.
All right. Opportunity zones. So we're going to talk a little bit about opportunity zones in the current law, and then we'll touch what BBB did. So just to start with, an opportunity zone opportunity zone incentives encourage investment in properties located and used within economically distressed areas designated as qualified opportunity zones. So these are a benefit to economically distressed areas. Investors can defer their eligible capital gain by investing in a qualified qualified opportunity zone, sorry. And the current incentives defer that capital gain to the end of 26. So we'll call that Ozone 1. And those, the taxes on capital gain taxes would be due on April 15th, 27. But these investments made before 1/1 of 27, so that's again the old law that we're still under, 1/1/27 before, and they're held for 10 years. You can then adjust your basis to the current fair market value. And if you sell your asset for current fair market value and the basis is current fair market value, then you have zero capital gain at the end of 10 years. Now, BBB changed a few things. Excuse me. Also, the current qualified opportunity zones will sunset at the end of 26, and then governors will be required to redesignate opportunity zones every 10 years. Now, the changes that BBB made will take effect after 12/31 of 26. So 1/1 of 27 will be the effective date for the BBB changes. So BBB allows the gain to be recognized in earlier years if it's in a qualified opportunity zone. And it increases the basis by 10% after 5 years and 30% if it's a qualified rural opportunity zone. And if the qualified opportunity is held for at least 10 years, it increases the basis again to fair market value, same as the current law. Now, I know we have, Ryan, we have a lot of opportunity zone investments and they have a significant tax advantage. Could you briefly walk through an example? And I believe the example you're going to go through is going to use the current opportunity zone law, not the BBB, since that's what we have available to us now.
Yeah, correct. We're not going to talk about the 2.0. I call it 1.0. I know you say 1, Kent, and I'm actually saying 1.0 and 2.0. But yeah, for 1.0, because 2.0 actually won't start until 2027. So that's going to be distant news for many out there. So opportunity zone can be very creative in taking tax off. So I'll give you an example. We had a person that sold a business this year. They had a large gain. Capital gain, they can roll the portion. It doesn't have to be all of it. It could be whatever you want it to roll over. It could be 1251 gain. It could be recapture. It could be tax, stock, public stock, private stock, you name it. You can roll that gain over into an opportunity zone. So in essence, for proper tax planning, we did all kinds of things to get the tax reduced down from the sale of the business. But part of that was rolling that into an opportunity zone. He will have to pay taxes in 2026 under 1.0, which will be due April 15th, 2017. But by doing that, he spread it out as tax consequence. So he won't get hit nearly as hard. It removed a lot of his modified adjusted gross income away from this year's tax consequence into next year, which will all be taxed at a much lower rate. So getting creative, but also taking advantage of what an opportunity zone is very lucrative, the ongoing. So that's the creativity portion. But then once it's into zone, you're not actually you're deferring the tax. I want to make sure that's clear, because a lot of people say, I completely eliminate the tax. That's not true. You're actually deferring the tax. Like I said, right now, if you'd enter into an opportunity zone this year, you're deferring it into 2026 tax year due 4/15 to 27 for taxes. So in this case, if you had $1 million that you rolled over in capital gain, you don't pay the tax again for this year. It'd be due next year. Next year, if you're in, that's the tax bracket, depending on where you're at and where you land. But let's just say you're in the top tax bracket, you have to come up with $288,000 by 4/15. Okay. There's different ways to get creative about taking that tax off. I want to stress that, but there's also ways to get creative in the event that you might have a stabilized asset by then, possibly. Or maybe you already did this. So if you're like myself, I did opportunity zones. I've done several of them. A lot of those assets are now cash flowing assets. And what will happen, and let's hope we get some more interest rate cuts, but this will give the operator the ability to refinance the asset, in this case, the real estate, and take some cash out and distribute that cash to pay our taxes, right? So there's different ways, but I would count on having that to pay that taxes. But where the real benefit comes in, as you hold that asset, a lot of people forget, they just think that once you take deduction, that's it, against or depreciate an asset out, then you have no recapture. Well, your recapture is all at ordinary income tax. So over the course of the life of the asset, as that asset is being depreciated out, like you'd want to do with real estate, that's how you get the tax efficiency and the pass-through of deductibility on your balance sheet. But with that, that's not free. Yeah, the government's going to claw that back once you sell the asset normally. Also, if the asset grows, so if this $1 million, call it 12 years from now, is now worth $3 million, that whole $2 million post-gain basis is completely tax-free. Also, the recapture I just mentioned completely goes away. So completely tax-free recapture. So that's the beauty of the opportunity zone. There's certain trusts that we use opportunity zone in, like taxable trusts, because in essence, it's like a kind of a almost like a Roth IRA type of structure to it that can be much more valuable in implementing in certain cases. So it's never one size fits all. I want to stress that, but that's the way the opportunity zone works. If you're ever worried about them doing away with adjusted basis and making what they call the 1031 exchange, like exchanging real estate properties, obsolete, opportunity zone might be a good thing to discuss the pros and cons and wait if that's the right thing for your particular situation.
Excellent. Thanks, Ryan. All right, we got one more section. That's the sale of Section 1202 qualified small business stocks, or QSBS. So to tell you what this is allows non-corporate investors to potentially exclude significant portion of the capital gain from taxes when they sell. The rule was created to encourage investment in early stage C corporations. Okay, so these are everything we talked about before, largely S Corp or LLCs, but these are now for C Corps. Gives us an opportunity. So BBB enhanced. So this is again something that's been there. The QSBS sale of QSBS has been there for quite some time. But the BBB created a new tiered exclusion for the that allows 50 and 75% exclusion for after 3 and 4 year holding periods, respectively. The 5-year holding period, which is what we had before, that remains unchanged. 5-year holding period is 100% exclusion. Also, so this will be for assets acquired after July 4th of 2025. So here's another new effective date, July 4th of 2025. What was July 4th this year? That's when the big, beautiful bill was signed into law. So these will be for Section 1202, the C Corps. These are assets acquired after July 4th of this year. Okay, and BBB increased that limit for each user per issuer to from 10 million to 15 million, or 10 times the basis, whichever is greater, making the maximum amount of gain eligible for exclusion to the gain, the greater of 15 million or 10 times the shareholder basis of the relevant stock. Okay, so that's a huge exclusion from gain. And it also increased the aggregate gross asset ceiling for the issuing corporation from 50 million to 75 million. So more companies might be able to issue the QSBS stock. And again, that goes into effect for stocks acquired after July 4th of this year. I think this is an additional, investment opportunity in small C corps. Ryan, would you review the example and kind of wrap up this portion of the presentation before we open up to more questions?
Yep, absolutely. So yeah, I've done many QSBS investments very strategically. Most of these investments tend to be a higher risk, higher reward, or smaller venture capital types of investments. If the valuation is below 50 million prior to July, 70, below $75 million now. But we definitely have some of those that we're expecting and are coming to fruition to have significant exit multiples, meaning very significant tax liability if they were not filed or not filing for the QSBS exemption. So this is something that we do very strategically, place assets in the right position. Okay, the only way to get the exemption is by not placing it inside an IRA account, right? As Kent mentioned earlier, a lot of people think they're told their entire life to save, and put money into a 401k, and then that money ends up in an IRA or IRA rollover, and it ends up being a tax monster, right? This may create an additional tax monster depending on how well your financial advisor knows how to source good investments, especially on the private side. So example of this, if you have a $2 million investment into what they call qualified small business, and again, C Corp is Kent mentioned. Also, it cannot be a service-oriented company. It has to be either manufacturer, tech, something of that nature to qualify for the QSBS 1202 exemption. So the sale after 5 years, there's also a phase out. So if you had a shorter term time horizon, the exemption would be, be less, a little bit less. In this case, after the sale after 5 years plus is 22 million, you have a $20 million profitable gain. That $20 million gain can be completely excluded from federal income taxes. So what does that mean? If you're going back into the federal and tax state of Nebraska, if you're in New York or one of those other places that has really high taxes, California, this is going to be a lot higher, but in the state of Nebraska with the net unrealized along with your capital gain rate and the state income tax rate in Nebraska, where Revolution Group is headquartered, 28.8%. Or $4.8 million in federal tax owed. And I've seen this blunder before. I've seen where accountants never filed for the 1202 and it would have been exempted. And I've seen this happen a few times. So again, you're only as good as your team, and we're here. We're of course here to help you out, to sift through a lot of the noise and a lot of the what can be done and can't be done. So.
I think we turn it back over to Chris.
Okay, well, we must have some really astute audience members back there because no one had any questions. But I think the deep dive was tremendous. So I thank you, Ryan and Kent, for going into that deep dive and places and providing that wealth of information. So we just want to thank everyone who did participate for their attendance. And our next webinar will be Wednesday, October 29th, so please mark your calendars. Our subject matter is to be determined, so if there's topics of interest, please feel free to send us your subject of concern, and we'd be more than happy to delve into those. If you need further information on any of the material covered today, please email us or using the QR code, which I think we're going to pop up here in just a moment. On the QR code now on your screen, simply grab a hold of that snapshot or simply email us at info@revgroupllc.com. So we will be sending out email reminders for future webinars in the coming weeks and would love to have you join us. So feel free to share any of the information about Revolution Group to anyone who you think may benefit from our services. So again, we thank everyone and look forward to seeing you in the near future.
Is there, just before we part ways here, Chris, is there anybody that has any Q&A? This will be a first if we have no Q&A, no questions. So we
No
want you to
Q&A.
raise your hand here, and if you have, we'll give it maybe a 20 seconds here just before we sign off. And if there's nobody after 20 seconds, we certainly appreciate you taking the time today. As always, if there's a way we can help, or you need more clarification on anything that was discussed today, just reach out. It looks like we had something that came on here. Okay, Patricia, looks like she said, I'd like to know about energy credit changes. Kent, I don't know how astute. I mean, we looked at doing energy credits and investments. I can tell you that both production credits and non-production credits as an investment. Those production credits are not very lucrative. Bank of America buys a lot of those production investment credits. We just don't think personally, from an investment standpoint, it's worth it. But I'll defer this back to Kent. If we don't have an immediate answer, Kent, what I would do is we'll reach out to Patricia, or she can reach out to us rather than us trying to really look for that. It looks like we might have had somebody raise. I thought I saw a hand raise. Do we have a hand raise?
I don't have anything here.
Okay.
On the energy credits, I can just kind of high level tell you that the individual and business energy credits for new and used cars, that was repealed, effective, and that'll go into effect the end of this month, September 30th. Those energy credits for solar, geothermal insulation, doors, windows, those all end at the end of this year, 12/31/25. That's kind of at a high level.
Okay, anybody else?
But you have your hand raised.
We've got one. When discussing charitable contributions, are checks considered a cash donation? That's from Andy.
Yes, they are. Yes.
Great.
It can checks, even if you pay by credit card, that's considered a cash donation.
Okay, good to know.
Yeah.
Is Kent best practice? I would imagine. I mean, check might be a good thing, but if you're giving to a donation, at least when we give to charities, historically, I've also gotten, I'm usually writing a check, but I'm also getting a receipt from the charity too as well. Is that best practice to also have the receipt from the charity?
Yeah, that is. And of course, if it's over $250 to a single charity, then they are required by law to send you a letter that says that here's how much you donated and you received no goods or services for the donation received.
Looks like
keep all those letters.
Okay, great. Looks like we got another follow-up question here. Chris, do you see that?
I actually don't see an additional question.
Okay, so this looks like from Patricia again. If you get solar batteries in your home, I'm guessing it says signed contract. Does a signed contract have to be completed by 2025?
So they have to be put in use. Contract, the date of the contract isn't what we're looking for. It's in use. So if you have them in use by the end of the year, then they still qualify.
Okay. All right, I think that should do it. We will appreciate you all on being on this particular webinar. We will have another one and have this be a regular occurrence on a totally different probably subject matter, knowing about around what Revolution Group is and what we do, of course. On a subject matter coming out soon. So I would say keep your your eyes peeled to your socials, Revolution Group socials, and if you haven't, follow us on I think Facebook, LinkedIn. I'm trying to think where else we're at. I know we're at a
Instagram.
couple. Instagram, okay, I guess we're at all over the place, but it's worth a follow. We do push some content out on there, and or get signed up for our on our mailing list for timely information is also very beneficial. We promise not to spam you. We're not that type of group. So with